Hi, I'm Daryl Jones, Director of Research at Hedgeye. Welcome to the fourth part in our series on inflation, among other topics. Very excited to have Jeff Snider, who is the Head of Global Research at Alhambra Investments, joining us today. He'll be coming in from West Palm Beach, Florida, which, as he was saying earlier, has been normal for longer than a lot of areas of the U.S., but we're very excited to have Jeff. Jeff, I thought the first thing, before we could kind of get into some questions, and as I said, I've reviewed some of your recent notes and tweets and research. I have a lot of great questions. Maybe you could just tell us a little bit about your background, then we could jump right into it.
Well, I have a background as a registered investment advisor, and I've been doing research and portfolio management for about 25 years, spending more of my time over the last decade and a half doing more research than portfolio management and things like that, simply because there's been a need to investigate some of these monetary conditions and what really goes on in this so-called plumbing, because economics has done such a horrible job of really highlighting how the system actually works. And if we didn't realize that back in 2008, then that was a pretty good example of people not knowing what's going on.
Right, exactly. So I thought there's one very interesting point in your bio. You very specifically say that you're not an economist. And so I'm curious how not being an economist actually helps you in terms of doing your research and maybe not being stuck in this sort of zone of academia that a lot of economists are stuck in.
Well, economists tend to be statisticians more than experts on the economy.
Right.
Which, I mean, that sounds weird because you would think that an economist knows a lot about the economy, when in fact it's really, they know a lot about mathematics and statistical regressions and things like that, and almost nothing about an economy. Economists spend all their time creating statistical models that usually don't really work all that well because there are various reasons. But so they're very good at creating models that don't work and aren't very useful. So the last thing you want to be, if you have an interest in the economy, especially monetary economics, the last thing you want to be is a trained economist, because you won't get much training in those things. So I'm not an economist, I'm not a trained economist, which I think actually helps, because I'm not spending all my time worried about DSGE models. I can spend more of my time actually figuring out what really goes on in the economic system globally.
Well, and actually it's interesting. Another point you've made a few times on Twitter is that a lot of these economists, particularly the ones that work at the central banks, actually aren't economists either. They're more akin to being janitors. So, kind of cleaning up the mess after the fact, which I thought was
and I think that part of that is because central bankers, well, first of all, central banks aren't central banks, certainly not in the traditional definition. And most central bankers, as we just said, they spend all their time with their DSGE models, which has very little use for monetary inputs or even financial system inputs. So most of their time, they're kind of spinning their wheels trying to put together regressions about, does inflation match with, the Phillips curve? Is the Phillips curve exploitable? Is it adaptable? All these other things that, really doesn't help you much given the real world situation.
Yeah, that's exactly right. So the first topic I wanted to talk about was reverse repo. And, again, you've tweeted about this, and I think this is very accurate, that a lot of people don't even really know what it is. They'll Google it, they'll read about it on Investopedia, they'll go on TV, talk about it in very broad terms. But on a basic level, and the reason I bring this up is because we've had a real ramp in reverse repo. I forget what the number was a couple days ago, but maybe you could explain in layman's terms exactly what this is, why it's ramping up, and what the implications potentially are.
Well, from a policy perspective and how the reverse repo window is designed to work, it's a tool for the Fed to soak up excess reserves. That's the idea behind it. When there's an excess of bank reserves or cash or any sort of thing like that, the Federal Reserve provides an alternative for cash lenders to actually lend cash to the Fed. And the reason they would do that is because they've set a rate for the reverse repo, which theoretically nobody would lend less than that rate, because why would you? If you're going to lend to the Fed at say 5 basis points, then you wouldn't lend to somebody else for anything less than that. And so by soaking up all these excess reserves and putting a floor rate underneath money markets, it allows the Fed, in theory, to control money markets, at least from the bottom, from the floor side. so that they can put a floor under money market rates to keep everything into the policy range, which is really all the Federal Reserve cares about. Are we keeping the federal funds rate, the effective rate, and all the related rates inside the policy range?
Yep.
And so the reverse repo is nothing more than, at least from the theoretical perspective, that's really what it's supposed to do.
Yep.
And so if there's an increase in excess reserves, a really large increase in excess reserves, and you see money market rates outside start to fall, you would expect that use of the reverse repo window would go up, because it provides money market participants that alternative to do something else with their free cash.
So why aren't these, I don't know if this is the right way to think about it or not, but why aren't these banks lending the money out to get higher returns? And what have you seen in terms of, I guess, loan growth and
that's such? Really the $1 trillion inflation question.
Yeah.
Why haven't banks over the last 14 years wanting to lend? And of course, it's a puzzle to any mainstream economist, because they're still looking at their DSG models and equations, when the banks have been pretty clear, not just in the US, but all over the world, that they don't want to lend. It doesn't matter what happens in the short run, in terms of short run money markets, for example. Go over to Europe, where the deposit facility rate for the European Central Bank has been negative for over half a decade, going on 7 years now. And why aren't banks in Europe lending? They're essentially being penalized for holding liquid reserves and doing nothing with them, not going out into the marketplace and lending, which is supposed to be what happens in a negative interest rate situation. Instead, banks have said, we're not going to lend. And so what that tells you is that their perception of the environment is that, risk-adjusted returns must not be there.
Right.
They'd rather get almost nothing or less than nothing on the most liquid assets, including, sovereign bonds and things like that, rather than go into more risky situations like lending, because they think the risks are just too high. The risk-adjusted returns, therefore, just too low.
And I guess this is, maybe a part of the big reason that you see, deflation coming probably sooner than a lot of people expect, just because this money that's built up on banks' balance sheets isn't actually getting into the system and isn't creating the sort of longer-term demand that you need to create longer-term inflation.
Yeah, and I don't even consider it money. It's really just another asset. It's another asset class that the banks hold. You look at a quantitative easing transaction, for example, and really it's from the perspective of the bank, it's nothing more than an asset swap. So it has a bond, it sells it to the Fed, and now it has bank reserves. So it's traded a bond for bank reserves, which is really just one form of asset for another. And in many ways that can be harmful, because at least the bond in repo and derivatives have some use as collateral. So it's really not just about lack of lending, but why are banks choosing to hold only the safest liquid instruments, and to do so year after year after year after year? And then, of course, consistent with that is the fact that we've had this quote unquote inflation puzzle during the same period. So the banking system is really telling you by its own behavior what's going on. And over the last year or so, despite the fact that the Fed has really ramped up its activities, the ECB, central banks all over the world, governments have ramped up their fiscal influence and interventions too, it hasn't really changed the behavior of banks. Banks are still not lending. They're still not expanding their balance sheet. They're still complaining about regulations like the SLR, for example. And so it's really, banks are telling you their perception of risk-adjusted returns in all of the stuff that we need them to do is too low for them to expand and grow and create the situation where we would expect some kind of inflationary environment.
Yeah. That definitely kind of makes sense from a longer term perspective. I guess thinking about the shorter term, I was watching some of your videos, I think from Real Vision, probably, end of third quarter, early fourth quarter of 2000. And you're sort of talking about the same sort of theoretical setup. Have you been surprised at all by, we have obviously seen inflation over the past 9 months. Some of it, of course, is, strictly due to the reopening. Maybe a lot of it is, but has that move in inflation, did that surprise you at all, or was that sort of what you would have expected to happen?
Well, I think it was surprising in certainly some of the last couple of months, some of the proportions it's taken.
Right.
But I don't think it necessarily should be surprising, because look, the federal government in particular has thrown trillions of dollars at the real economy. and thrown trillions of dollars at a real economy that's been constrained in a lot of different ways, a lot of different artificial ways. So you have obviously an imbalance between demand and supply, which is always going to create some these supply bottlenecks and therefore price deviations, which is, to me, that's more of what's going on. It's a price deviation rather than something like inflation, whereas inflation is, in my view, is a broad-based, sustained consumer price increase and acceleration that goes on because of the monetary environment behind it. Whereas what I think we've seen over the last year is more of this imbalance between demand and supply, huge amounts of artificial interventions and things like that.
Yeah, exactly. And obviously sort of massive supply chain constraints, we kind of see that globally.
I mean, commodities, you can see it pretty much everywhere. There's definitely, backwardation across how many different commodity curves that basically tell you that suppliers are not producing in the way that the market demands. And so, it's a price deviation, and a pretty sharp one. And I think that's however you want to look at the government's intervention and think, well, that's a good thing that they because of this fiscal aid, it allowed that the economy to at least generate some level of spending that was better than what it would have been without the stipends and aids and things like that.
So we're of the view that inflation, while it may decelerate to some extent, will remain higher, at least through the course of this year, than I think a lot of people are expecting. And it kind of goes to these same structural or shorter term structural constraints that we're talking about, plus a gradually improving economy, both in the U.S. and in Europe. China is a separate topic, which we can get to, but how do you see deflation playing out from here? We've obviously seen some in terms of, and you've been tweeting about this a lot, certain commodities have come well off their highs, lumber as an example, although lumber is still up 100% or so year over year. But we look sort of the next 6 months, how does deflation or inflation play out in your mind?
So I think, I don't think we're going to see any outright deflation anytime this year, because I think the economic fundamentals are still improving.
Right.
But I don't know. I mean, it's really difficult to tell how much quote unquote inflation there will be over the rest of the year, because it's really difficult to tell how the economy is going to progress because there's so many unknowns involved in it.
Right.
And I think that's one thing that's certainly driving the bond market's skeptical view of the inflation scenario, because there are just way too many unknowns. And it could just be something like, as supply comes back online, or as the economy starts to recover, everything starts to reopen, Americans in particular start to spend less on goods and more on services.
Right. And
that shift in demand could actually reduce inflation, at least to some extent. And that could actually take some of the pressure off of this price deviation. So there's any number of ways I think you could see inflation maybe underperform in the second half of the year, but I don't think that necessarily leads to deflation, certainly not in 2021 or anything like that. I think it's more of, what does the long run environment look like, and what does it look like after this year? How badly damaged is the global economy from last year's recession, and really the inability to rebound from the bottom.
Another thing you've been tweeting about and talking about a fair amount is China's balance sheet, and I guess this idea that it's not really growing anymore. What are the Chinese signaling to us, or what are they trying to tell us, either directly or indirectly?
I think they're laughing at us. When you look at the People's Bank of China's balance sheet, the major component on the asset side is foreign assets, which is nothing more than a legacy of the Chinese system being built up from way back in Deng Xiaoping's Southern Tour. And they dollarized their monetary system to a great extent. But over the last almost 2 years, the level of foreign assets on the PBOC's balance sheet has been almost a perfect straight line across, which is, that's obviously engineered, and you have to ask yourself why. And at this point, they're obviously doing some kind of thing, some kind of transactions in the shadow to make it appear that way, and really attempting to either hide what they're doing or obscure what they're doing for reasons that aren't readily apparent. Because you would think that if the dollar system is growing again and everything's going back into certainly more of a normal situation, we would expect dollars to flow onto the PBOC's balance sheet. And the fact that they're not, or at least that the PBOC is attempting to engineer this major line item in its balance sheet, it's sort of an indication that something must not be right here. At the very least, it must not be normal, because otherwise we'd see the dollars come in and everybody would be happy. The PBOC's balance sheet would grow and expand and everything would be hunky-dory.
So what is it that is it that they're afraid of their economy overheating to some extent, or why exactly are they doing that?
There's any number of possible reasons.
Yeah.
I think it's because the dollar flows have been much, much less than people have been anticipating, because, as everybody knows, the common narrative over the last years, Jay Powell flooded the world with dollars.
Yeah.
And if he had done that, you would expect a flood of dollars to show up, especially in China's balance sheet, or the central bank balance sheet. And the fact that it isn't is already a red flag. And I think that's part of the reason. There's also any number of possible explanations where the Chinese are using their state-owned firms to essentially hide dollar shortfalls, capital shortfalls, whatever you want to call them.
Yep.
There's potentially Chinese corporates that are not repatriating dollar balances that they've obtained, especially from the merchandise surplus that the Chinese have run over the last year. Keeping those balances offshore for whatever reasons and out of the hands of the PBOC, which is another set of red flags there. So no matter how you slice it, or whatever reason you want to come up with, it's unusual. It's really unusual. And the fact that it's gone on for as long as it has, especially over the last year where everything's supposed to be going in the right direction,
right,
it's an indication that something's not right here. There's at least something that's off.
So this is actually an interesting segue to crypto, because you'd also been noting that some of these countries that have smaller, kind of maybe less modern or less Western countries have been adopting crypto as more of a mainstream currency. And I think what you tweeted was that the way to look at this potentially is that there's actually a shortage of dollars, so they need something that's maybe more of a proxy for dollars. Is that sort of your thought?
I think in a lot of ways it's just basic elasticity, right? As you just said, Daryl, I mean, the world is short of dollars, not flooded with dollars, but short of dollars. Right. And therefore, if you're a small country and you can't get dollars for, you need dollars because it's a global reserve system, and without it, you can't trade, you can't participate in the world marketplace. So if you can't get dollars, you got to find some other way, some other monetary medium to be that's acceptable in a broad-based fashion that you can therefore access world markets from. It would make sense if you can't get dollars to turn to some other form of currency in order to create some kind of elasticity, because that's the thing that's really missing. And I really think that's what's driving digital currencies and cryptocurrencies in general. Yeah. Not that the Fed is, flooding the world and printing money and going crazy in that respect. I think that's what the public is mistaking and buying and pushing crypto prices up for. But I think the use of crypto, the advance of technology and innovations is really being driven by elasticity issues that go all the way back to the first global financial crisis. Yep. I don't think that's an accident that the first Bitcoin block was written during the depths of that crisis.
Right. Yeah, that's exactly right. So what as I guess an RIA or as an investment management firm, how do you recommend to your clients, or how do you get your clients positioned in the crypto space? Obviously, very highly volatile assets, so you have to be aware of that. But you have an interesting thesis here, which is the demand maybe not because the Fed is printing dollars and it's a safe haven, but rather that the world is short of dollars. So this is an alternative to that people may be adopting more and more. But how practically do you recommend to clients to get involved in crypto?
Yeah, it's very different when you're looking at crypto as a store of value, as I think most of the public is doing right now. I mean, look, everybody hears that the dollar's crashing, inflation's going to be insane, and so everybody piles into Bitcoin and all the other ones because they think, they got to protect themselves from the dollar's crash. And I think that if you realize that that's a mistake, and that's really what's driving the volatility in those prices, instead looking at crypto and digital assets from a long-term perspective of a medium of exchange, which I think is the elasticity, the proper way to view them, then you want to stay out of these wild swings and volatility and take a more long-term approach. So I don't think it would be advisable to be buying crypto assets right now, especially with as high as they are. There's probably going to be another time, maybe repeated times, when you can buy some of these things at really dirt cheap prices. Because as we saw in 2017, when the last time crypto assets went parabolic for pretty much the exact same reasons, the dollar was going to crash, inflation was going to go nuts. As soon as everybody realized that wasn't true, everybody piled out of crypto.
Yeah.
And the crypto prices all crashed.
Yeah.
And I think we may be seeing the same thing here. You go back to October of last year, that's really when this latest parabolic move started,
Yeah.
which was, same thing. Dollar's about to crash. Jay Powell has done way too much. And then, here we are in June of 2021, and wait a minute, maybe that's not the case. The dollar seems to be really hanging in there. Maybe it's a little bit stronger against most other currencies than most people maybe anticipated. And there's all sorts of questions about this inflation stuff. So,
yep.
Now crypto is suddenly less of a hot commodity or a hot item.
So, the one reason I really enjoy reading your work is that you do a lot of historical analogies or analysis, look at what's happened in the past. And one thing you'd mentioned, which I'd never heard of as it relates to crypto, is something called ghost money. And I think your point was, obviously crypto is new, it's a new technology, but we've seen this sort of story before, and ghost money I think was an example of that, but I actually wasn't even sure I didn't get a chance to go to Investopedia and look it up, so I'm curious what ghost money is and what the history there is.
Yeah, and it sounds like digital currencies are a brand new phenomenon. And in one respect, they are. I mean, the technology is obviously new, but there's this idea of monetary shortage and lack of elasticity and private economy participants doing everything they possibly can to work around them. That's something that's historical. It's ancient. It's something that human beings have always been trying to do since there was a modern economy. And really it makes sense, because when you look at what money really is, it's a tool for an economy to be efficient. And really, when you look at money as a tool, the last thing you want is to have, to have a shortage of that tool interrupt what would otherwise be useful commerce and sustained commerce. And so you go all the way back into the late medieval period, for example, during what was called the Great Bullion Famine, when the European continent in particular found itself short of especially silver coins. What arose was essentially this ledger system, really a distributed ledger system, very much like crypto, very much like the Eurodollar system, where merchants got together and rather than having currency, because it was hard to find and source currency, they would simply just keep a track of who owed each other what, and that means of settlement created enough elasticity that certain pockets of the European continent, which were experiencing this great bullion famine, actually didn't have the same level of deflationary and depressionary consequences that maybe other parts did. Yeah. So the idea of private agents getting together and sort of creating their own form of fictitious currencies or ghost money is something. It's an ages-old story.
Okay, another analogy you often point to is Japan, and sort of the parallels between Japan's inability to maintain any sort of inflation and what may be happening or eventually happen in the U.S. and even globally, given that we're stuck in this sort of zero-bound, I think you called it zero-bound trap. But what can we learn from Japan? That's the first part of the question. And then how do we get out of this zero-bound trap, or can we?
Yeah, I don't think we've learned anything from Japan, because we keep repeating exactly everything that they did, almost exactly. So, again, economists, right?
Exactly.
Like, here we have a perfect example of what not to do, and yet right from the very beginning, we've repeated almost exactly down to a T everything that they have done, and of course, for some reason, everybody seems to expect the results to have been different, and I think that goes right down to the central bankers at the Fed, who, when they studied quantitative easing in particular, but also money, finance, fiscal expansion that the Japanese undertook in the 90s, their conclusions was always, well, this is sound theoretical. If it didn't work in Japan, it's because the Japanese screwed it up. And when the time comes that we'll do it right. Except that it just never has been the case, from quantitative easing on down. And now we get into heavy fiscal expansion, the idea that it's going to somehow turn out to be different, to me, boggles the mind, because here we have a perfect case example, a lot of empirical evidence that shows what we should expect. And what we should expect is exactly what we have seen.
Yep. So, thinking about the path of the Fed over the coming quarters or coming year, what is that going to end up looking like? I mean, if you take the Hedgeye view, which is that inflation continues to come in hotter, it sounds like your view in the short term is maybe you don't really know for sure. There are reasons it could be come in lower, maybe it could come in higher. But how does this play out for the Fed over the next 12 months?
I don't think much changes over the next 12 months because the Fed is going to be incredibly careful about changing its policy stance because they've got this in their head or they're in their models that any kind of premature action will interrupt the recovery before it reaches any kind of any kind of sustainable point. So I think the Fed's going to do exactly what it has done, even if inflation continues, as you guys expect. Even if inflation continues to come in a little bit hotter than hotter than maybe they're anticipating. I still think they're going to take a very measured approach and say, transitory. This isn't really inflation. The economy's still got a long way to go. We're nowhere near maximum employment and full potential. Therefore, we're just going to continue to do what we do until we actually see that has changed. And I think that's probably the right approach, assuming you believe monetary policy has any kind of real impact here outside of sentiment. I think that's probably the correct approach because there are, far be it from me to agree with Jay Powell, but I think, he does have a good case when he says, look, the economy is still running under significant amount of slack. And there are all sorts of artificial impositions taking place. So it's really difficult to say we are at a point where this thing is now going to overheat and continuously overheat for the foreseeable future, and we got to do something about it.
So when you say the economy is still operating with a fair amount of slack, which, by the way, is something we would agree with, what are you focused on primarily? Is it the labor market you're looking at, I guess? Or?
Yeah, labor market, also supply, production side. Why? It's one of those things when you see, why is, for example, in the oil market, why are oil producers, they haven't brought back online most of their production that they took offline over the last year with oil prices continuing to rise? Why are we seeing production levels continuously suppressed? That's not all because of supply bottlenecks or chip shortages or things like that. I think there's a view from the production side of the economy that some of these things are transitory. These factors are transitory. They're not going to play out over the longer run. And that's part of it too. And there's also, there's any number of other factors in the labor market, which we can say, well, that's a temporary factor. Maybe when schools start to reopen and people start to come back to work, maybe that will help bump up the employment statistics and the rebound in the labor market and things like that. But there's also, a number of indications that suggest the labor market itself has been severely impaired. And impaired in not just a short run way, but in more of a long-term possibility where, like the last time we went through this in 2008, 2009, we're going to have lingering slack that's going to continue to depress the price pressures through wages and things like that.
Do you think part of the slack has come from, I guess, longer-term unemployment benefits that have really, to some extent, and some of them are now rolling off, of course, but incentivize people to stay out of the labor market, longer than they normally would, so then it becomes harder to get back into it because the labor market's interesting. Almost any data set or data point we look at shows that jobs are just incredibly difficult to fill. Yet, they're not really. They are getting filled to some extent, but how do we think about these two imbalances, right? On one hand, you have every employer in the world saying they're looking for more employees, but you do have slack in the labor market. We know there's still a lot of unemployed people. How does that ultimately settle out?
Yeah, and to me, I think that's interesting, and I think it must be some sort of hidden slack in terms of wages too. Because you're right. I think everybody's saying we want workers. We want workers. Airlines, for example, they seem to be desperate for workers, but yet you hear these anecdotes from, say, American Airlines, where they say, "Well, we want workers, but we don't want to pay them." So it's like, okay, is that a labor shortage, or are you hurting so bad you can't afford to pay a market clearing wage to bring people off the couch and out of the unemployment rolls? And I wonder if it's, obviously there's probably some of both here. There's got to be some probably millions of Americans who are saying it's not worth it for me to get off the unemployment roll and therefore go back to a job that probably is going to pay me a little bit less. I might as well just stay on unemployment. But you have to wonder how many companies are out there who aren't really willing to pay a market clearing rate to get people to do that. And that's why the labor force participation rate, for example, has been flat for almost a year now, going back to last summer, where people are not coming back into the labor force for some reason or some combination of reasons. And I do have to wonder if it's the fact that companies are really hurting, outside of government interventions, paycheck protection program and things like that have kept them afloat. They really can't pay wages that workers want them to be paid. And that's why there's a tremendous amount of slack. And that kind of long-term problem could continue to plague the system for more than just, for quite a while.
Yeah. I guess to your point, it's likely that to incentivize more workers to come back, they have to pay more. They have to be comfortable paying more, of course, but that potentially is somewhat of a leg to inflation in the short term. I assume if we start to see wage increases, drive the labor force market participation up. But to your point, maybe it's because corporates really aren't that comfortable about the future at this point, and that's why we still have this sort of jobs are really hard to fill, even though there are people out there that want jobs. But ultimately, to your point, it has to come from wages, probably.
Yeah, and I think that's really what it comes down to, is that jobs are hard to fill at the rate that companies seem to want to pay.
Right.
Which again, to me, that's not a labor shortage. That's a shortfall in the real economy, because you would expect activity, revenue potential. As you point out, Daryl, it's a risk-taking situation, right? Companies have to take a big risk, bringing on this additional cost, additional cash flow cash flow burden, and things like that. And if they're not completely 100% certain about the trajectory of the recovery or the rebound from here, they're going to be reluctant to do so. And I wonder if one of the things that we saw recently in the JOLTS data in particular was the high level of quits. I wonder how much of that was, hey, let's bring some people on. We'll bring them on at a lower wage rate and then promise them to we'll pay you more down the road. And it got down the road, and it's like, we don't have any more to pay you. And people said, okay, I'm not going to stick around if you're not going to pay me what I was expecting.
So I'm going to go to the question queue now, and we've touched on some of these topics, so maybe some of them we just hit on quickly. But the number one question here, no surprise, this is from Brian Banish. Please give us your read on the reverse repo market action in recent days. $750 billion in overnight activity is a big move. Combine this with the U.S. dollar rates and gold moves last week. Are we seeing a euro dollar shortage developing? If so, what should we expect in the coming days and weeks?
Well, to me, the reverse repo, and we didn't really get a chance to talk about this earlier. We went over theoretically what the reverse repo is, but to me, the reverse repo is mostly about collateral, because that's really what comes back on the other side. If you're lending cash to the Fed, it's collateralized by the Fed security in SOMA, and so it's an indication of potential collateral constraint or scarcity. And so I think that's why, for example, you've seen the reverse repo usage start to spike in the middle of March, which is the exact same time as you saw long-term treasury yields begin to fall, which if you're looking at reverse repo as, hey, there's too much cash around the world, excess reserves, why wouldn't that be further inflationary, therefore reflationary into long-term yields? But if you're looking at reverse repo as an indication of potentially collateral scarcity or constraint, then that would make sense why we're seeing falling yields, because the marketplace is having to deal with that collateral constraint and scarcity, which would be negative over time in terms of growth and inflation expectations and potential. So I think to me, the reverse repo is more about, yes, there is some of this, there's excess reserves and excess cash looking for a home, and bumping it up by 5 basis points to pay 5 basis points definitely increased usage there. But I think the overall story in reverse repo is about collateral and constraint. That doesn't necessarily mean the system's broken and things are going badly and it's horrible out there or anything like that. I think it means that the system may be more fragile than people anticipate. And that's why, again, anti-reflation in long-term global bond yields, because that indicates, a fragile system is one that's more likely to head back in the wrong direction, the deflationary direction, over time.
Okay, this is a bit of a follow-up to that question. This is from Jennifer Cristo in Cincinnati. Is reverse repo a type of monetary tightening? And if so, will this keep the longer-term inflation expectations at bay because of the lack of lending? I think this is sort of what you're saying. Is that what caused the bond market to react lower on the highest CPI print in recent times?
Yeah, no, I don't think we want to look at reverse repo as anything other than a temporary measure. It's not like quantitative tightening, where quantitative tightening is an intentional policy to reduce the level of systemic bank reserves. So that's what the Fed was doing back in 2017 and 2018, which was, quite intentionally reducing its balance sheet. This is really just a temporary measure to soak up, as I said, excess reserves, at least from the policy perspective. So it's not really reducing the level of bank reserves as it is giving those bank reserves another place to go for a short-term period of time.
So this is sort of along the same theme. This is Tim in St. Louis. Well, we're seeing a ramp up inflation here in the U.S. What factors could lead to deflation? You've sort of touched on that, but it seems the endless dollar printing has no end, and the Fed has placed themselves in a corner with hyperinflation, the end game. So this is obviously what a lot of people talk about, but just this idea that they're going to have to keep printing dollars forever. We become the Weimar Republic or whatever, and it's just this hyperinflationary spiral, which is of course not the view you're taking. But how do people get confidence that that's not what's going to happen?
Well, first of all, the Fed doesn't actually print dollars. That's really one of the major.
But that's what Investopedia says they do.
Exactly. No, that's you have to realize what the Federal Reserve actually does, and it prints bank reserves, which are not dollars. They're simply an accounting leftover, or accounting byproduct, whatever you want to put it. It's not really effective money because the effective monetary system is completely different. That's why, going back to 2008, 2009, we've kept hearing Weimar Germany, hyperinflation, the Fed's going to lose control of the dollar's going to crash, and it never happens. In fact, the opposite has happened, right? Going all the way back to that much length of time, inflation has underperformed, not overperformed. The dollar has gone higher, not lower. And the reason is because the Fed doesn't print money. The Fed doesn't actually have much to do with monetary policy, money in monetary policy to begin with. And in fact, as we said before, my view, it's about a monetary shortage, lack of elasticity in the effective monetary system, which produces all of these other implications and effects, including the fact that we haven't seen the hyperinflationary collapse because it's not really happening. And really what the Fed is doing is trying to simply slap some Band-Aids on everything and try to get people to believe that it's fixed the problem, hoping that just in getting people to believe in that situation, or getting them to believe that they fixed the problem, they'll act as if the problem has been fixed, and therefore everything will become fixed. It's almost a circular logic.
Yeah. So the point is, it would be very different if what they were doing is, instead of printing from an accounting perspective bank reserves, they're actually sending that money to people. And if they were doing that, then the money, then it's more inflationary or potentially hyperinflationary. But the money is basically, it's a sort of an accounting scheme in some ways.
Yeah, and that's really, we've seen this going all the way back to Japan, to bring up Japan again. And what even central bank scholarship on quantitative easing, what you'll see, all of these various studies throughout the last 20 years of QE have said is, if you've got a problem in the banking system, forget it. None of this stuff will work, because the banking system, which is where real money comes from and what real money is printed, then if you've got a malfunctioning banking system, it really doesn't matter what the central bank does, because in reality the central bank isn't really a central bank. It's sort of a bank regulator that attempts occasionally to again do this sort of expectations-based policy to get people thinking that it's doing money when in fact it actually isn't. And eventually over time people start to catch on to that, and then monetary policy, what limited effects it may have had in the beginning, simply just doesn't matter anymore at all, which is what we've seen in Japan. I mean, you think back to Japan and QQE in 2013, which is supposed to be this epic amount of money printing, and after not even a couple months, it was largely forgotten and left off of the mainstream news media even.
Yep. So this is Brian in Hawaii. Jeff made an astute comment that the Federal Reserve Chairman appear to have a good grasp on how things work once they're out of the position. Can you riff on this a bit more? We're being lied to, and they know they're lying, and will continue to toe the party line until they are out. So I don't know if you have any more thoughts on.
Yeah, it's what do you do if you're not really a central bank? You sort of have to keep up the charade, right? Because expectations-based policy requires you to play the role of omniscient, omnipotent, almost godlike stature. And really, if the very moment you say, well, maybe this stuff doesn't work, or, we don't really do what we told everybody we do, it all just falls apart. So you almost have to keep spinning the wheel, you almost have to have the music continue to playing, because as soon as the music stops, it's not that there aren't enough chairs. There are no chairs whatsoever. It all just kind of falls apart.
Yeah.
So the Fed really doesn't have much alternative other than to just continue pretending that we do this QE stuff. It's helpful. Our toolkit is completely filled. We got all sorts of other things that we can do. We're not completely powerless, and maybe we don't know what's going on with inflation, but we'll figure it out one of these days.
Okay. So question about banks, particularly interesting with the flattening of the yield curve. But the question here is from Zane and Cornelius. Are traditional banks just stuck in a bad model that will not work? They don't lend and can't grow. Does this mean we should be looking closer and closer at fintech investment opportunities?
I love fintech and decentralized finance, because I do think that's one way to work around some of the problems, the structural problems that are in the banking system. And I think that's what the question said. I think that's a lot of it, is that the banking model that had developed and worked, or at least appeared to work for so long, obviously has been proven that it doesn't work anymore. Banks aren't willing to take risks because the system is aligned against them doing so. And really, to fix that situation, or to get out of that situation, we would need some type of real serious reform, or doing something very seriously different. And I think, excuse me, I think, decentralized finance and things like that, fintech, that would absolutely be a way to maybe, overcome that divide or constraint, such that, the system could have a chance of, growing and expanding and doing the things that the economy actually needs for the economy itself to grow and expand.
So we're going to get into the last couple minutes here. We're going to get into the sort of crystal ball type segment, and I don't know how much detail you want to get into, but thinking about your worldview, your economic view, and we'll focus more on the U.S. But what kind of asset classes should people be looking at, considering right now? And I don't know how kind of low you want to go in terms of this specific sector ETF, but are there asset classes you guys are advising your clients to be overweight at the moment, or think about overweighting kind of going into the next 6 to 12 months?
Yeah, I think we're in sort of a transition period here. Yep. So the things that we were overweight up to this point, we're starting to consider whether or not we should still continue to be overweight those, because is the reflationary trade starting to roll over? What does that do as far as the risk profile of various assets? Do we need to shift into, say, a more long-term duration in bonds and things like that?
Yep.
Because if the reflation trade does roll over, that's probably the best place to be. What are we doing with commodities, and where does gold fit into to the commodity piece? More gold, less general commodities.
Yep.
Any number of different things. And I think we're in that transition period. It's the time to really analyze and think real long and hard about, does reflation have more legs? Does this thing go on a little bit further? Or are we really rolling over and moving into completely different? I know, as you guys put it, into a different box.
Yeah.
On a different quadrant on the chart.
Yeah. Yeah. No, I think it's something we talk about, analyze, and struggle with a lot. We've had this. We call it quad 2, but this really great 9 months of quad 2, sort of the reinflation, and then the question from here is how much more does it have in terms of legs, and then when does the next transition come? So I think you're struggling with it. We're not struggling, but we're all trying to kind of.
Oh no, we're struggling. Yeah. You have to struggle with it.
Yeah, I think we're all trying to figure it out. So
yeah, there's so much uncertainty. There's we don't really have a template where we can say this this historical case fits what's going on today, so we can use that as a guide.
Yeah.
I mean, we're really kind of flying blind in a lot of different ways. And I think that's where you really have to be grounded to market prices and particularly the bond market and money curves and things like that, to really guide you and guide your sense to what is the future intermediate term going to look like? Are we going to see more reflation, or are we not? Because that's really the key here.
Yeah, and so I guess thinking about that, where do you see yields in 6 months or in 12 months from now? Like the 10-year yield is an example, and maybe this is in the camp that we're still trying to figure it out because we don't have a concrete view of the future because it's so new and unique. But if you're right, where are yields, at some point, 6 months or 12 months in the future?
I think they're about the same to perhaps a little bit lower, assuming, of course, that we're kind of in the same situation where it looks like reflation isn't necessarily going to get any stronger or reignite, and maybe that doesn't mean we're into the next deflationary wave or anything like that. But I think abundance of caution, the way the market is positioned, plus all of the stuff we just talked about, reverse repo, collateral constraint, and things like that. I think those things are going to tend to weigh on yields a little bit. And if we do start to see things really roll over more, obviously you would expect yields to go much lower than where they are now. And eventually, longer run, who knows what that looks like.
Yep. All right, we're going to wrap it up there. Thanks very much, Jeff, for joining us. Very informative and educational as always. And I highly urge you to follow Jeff on Twitter or subscribe to some of his research that he writes for his firm. It's very interesting stuff with a lot of great historical analogies and very kind of on-the-spot, real-time analysis as well. So thanks a lot, Jeff.
Thanks, Daryl.
Yep, take care.